Thank you for joining us today. We're very fortunate to have Coe Isom join us and discuss tax policy. This is the third session of our March Marathon webinar series. We covered various topics, and this is the third topic we'll cover on tax policy. And we, like I said, very fortunate to be joined by Coe Isom. We're hearing a lot of discussion about what might happen with tax policy coming up in Congress this year, based on the changes that we saw through both the House and the Senate, and of course the Biden administration taking over. And they've got some proposals out there that right now it's kind of just I wouldn't say just talk. But we haven't seen hard proposals just yet, but based on the discussions through the campaign and then early on the administration, what we may see coming that will impact Indiana corn and soybean farmers. So if we can move to the next slide, please. Just go over the agenda real quick. I'm Steve Howe. I work for the Indiana Corn Growers Association, the Indiana Soybean Alliance. That's who's bringing the program today. We'll have a presentation by Beth Swanson as well as Kayla Jenkins from Coe Isom. And then I'll just cover some of the upcoming events that we have coming up this summer with our activities to get our policy work active for the summer. And then we'll have a little membership message and then closing remarks to wrap up today's session. Again, the presentation is today. I'll be joined by with Kayla Jenkins, and Beth Swanson will be joining us. I'll just introduce Beth. Kayla had a previous engagement that she's just wrapping up. She'll be joining as we move through the presentation, but I want to introduce to you Beth Swanson. Beth is a senior associate and consultant with Coe Isom. Beth is a member of the firm's National Tax Solution Team, specializing in advising business owners on employee compensation and benefits, tax strategies, reorganization, and tax law changes. She also advises individual clients on estate planning with a focus on helping family businesses transition to and thrive into the next generation of stakeholders. So glad you do this kind of work. It's very complicated tax policy, and then understanding how those tax implications impact family business, particularly a farm. And of course, I've thought about for myself, I need to go through that estate planning, have a plan ready. And then I got to thinking, is it worth paying a lawyer $100 so he can divide up 50? I don't know, Beth. But maybe you'd have some advice for me there. But no, I really appreciate you joining us. So I'll turn the program over to you and just let us know kind of what you see coming as far as tax policy. And I just want to mention that the president's going to announce very soon his infrastructure plan, and he says it's going to be paid for, which is good. Sounds like good policy, but how is he going to pay for it? And that's where we really need to watch that and be prepared as these proposals come forward, and how do we advocate for corn and soybean farmers here in Indiana. So Beth, great to have you. I'll turn the program over to you.
Yeah, thank you, Steve. Great to be here. Good afternoon, everybody. We wanted to get started today. Kayla, like Steve said, will hopefully be joining us shortly. I'm Beth Swanson. In addition to everything that Steve has mentioned, I have been helping lead the firm's effort in terms of CARES Act and PPP benefits. So if you're familiar with Coe, Kayla and I probably are both familiar faces at this point. But in case you're not familiar with Coe, I wanted to give a quick background on who we are and what we do. So we are a national agriculture advisory and financial services firm. And we started as a traditional CPA firm in Salina, Kansas, about 80 years ago, and have since grown to have offices nationwide. with a specialized focus in agriculture, and particularly with our roots in the Midwest, row crop producers, in particular commodity crops. We focus really on our client success, especially as it relates to profitability, and with that, constantly looking toward tax law changes and updates that could potentially impact the folks that we work with. Our goal as a firm is really policy to plate. So we focus on agricultural policy, federal affairs. We have a farm program services team. We focus a lot with sustainability as well. Additionally, we have financial resources and ag planning resources. We specialize in, especially here in the Midwest, with folks who grow commodity crops, animal agriculture, food and beverage, as well as biofuels. We also have specialized groups that deal with the marketplace, transportation and distribution, grocery, retail, and the like. So really from top to bottom, from policy to plate, we have a group of specialized people who can help with practically any issue. We wanted to set the scene, as Steve had indicated. The president is expected at really any moment, and if Kayla's and my last year or so is any indication, probably while I'm speaking this afternoon, the president will unveil his infrastructure bill and get more specific about these potential changes that we've sort of gazed into our crystal ball to flesh out the details around. So we expect that Congress will use the budget reconciliation process to develop the infrastructure package, and with that infrastructure package, the tax increases, or as Steve had rightfully indicated when we were chatting just before the program started, reductions in tax benefits as the ways that typically things get paid for. The budget reconciliation process requires only 50 votes to pass in the Senate, which is going to be critical for Democrats, since the typical process requires 60 votes, and the Senate is currently evenly split. This is the same vehicle that Republicans used to pass the 2017 Tax Cuts and Jobs Act, and was used again most recently in the 2021 American Recovery Plan Act, which brought us the new $1,400 stimulus payments. The Secretary of the Treasury has indicated that tax increases are going to be likely in this infrastructure package, and will involve spending and investments over a number of years in key Democratic agenda items like education and infrastructure. And she indicated that her expectation is that tax increases will apply to pay for these investments, and that these will probably be phased in over time. We're taking this to mean that it is pretty unlikely that any sort of tax increase will take effect in 2021, but rather take effect in 2022. One thing that's critical here is that compromise is required, because the Senate is tied 50-50 and the House's Democrats' margin is pretty narrow as well. Because it's critical for Democrats to come to compromise with moderate Democrats at the very least, it's pretty unlikely that any sort of tax changes are going to be terribly progressive. We will likely see some tax increases, such as raising the corporate tax rate, but we likely won't see a wholesale repeal of the 2017 tax reform. The package will be tied to, as I had indicated, a significant infrastructure and climate package that will probably have broad Democratic support. Our expected timeline here, I will turn it over to Kayla Jenkins to talk to us about sort of the expected timeline of these bills.
Thanks, Beth. Hi, everybody. So tentatively, this is what we're kind of thinking an expected timeline will be. However, just be aware that some of this may change and ebb and flow. So currently, right now, we're thinking it's going to look like an April, May for hearings on the next budget package. And then June and July, we're really thinking, you know, we kind of may get legislation moving with a goal to complete before the July recess. Fingers crossed. Let's hope that happens. And then when we get into September and October, you know, continue to kind of follow through that legislative process. And then tax provisions, what we're thinking as of right now, based on all the commentary that we're hearing, is those tax provisions won't take effect until the tax year of 2022. Typically speaking, when we kind of what we're looking at right now, the tax provisions won't happen until that next year. Very few times, very rarely would we ever see where they would go back and retroactive those tax provisions. Now, the green and other stimulative tax incentives like the credits, those could be retroactive to the 2021 tax year. So we're going to be monitoring those as time goes on here, what they're going to do and timeline and how quickly. So this may be a long drawn out process through 2021, or it may be a quick process. It just really kind of ebb and flows with how everybody's looking at, you know, the next couple of months. So as we kind of go out of the timeline here, Beth, there's a lot that we've got to think about, you know, kind of what's at risk. Where do we go from here? What this looks like, what gets impacted. So kind of help walk us through really what is at risk for a lot of producers and business owners.
Thanks, Kayla. Yeah, so when we thought about sort of what a tax reform preview would look like, we really cut down the chatter from all of the different possible proposals to really what the biggest impact areas could possibly be. So they really fall into two main categories. The first is increased tax rates sort of across the board, and then there's also estate and gift tax issues. There are a number of different manufacturing incentive credits and expanded credits for individual income tax that likely will get passed. But in terms of the things that are critical to plan around in terms of what could potentially increase your tax bill, the two main categories are the tax rates as well as the estate and gift tax issues. So first, increased tax rates. The president's proposals on the campaign trail and the chatter that we've been seeing is that there will be increased tax rates for individuals with taxable income over $400,000 for single individuals, increased tax rates for individuals with more than $1 million in capital gains, individuals with income from partnerships, S corporations, Schedule C businesses, and Schedule F operations, and increased tax rates for corporations. Let's talk about the individual income tax rates. So currently there are 7 tax brackets ranging from 10% to 37%. And President Biden has suggested increasing the top marginal rates and having those rates take effect at $400,000 of taxable income. This is an increase in the top rate of almost 3%. So the effect here is if you're a single taxpayer with taxable income of $500,000, your tax on the last $100,000 of income that you earn will go from $35,000 under current law to $39,600. This is we're expecting that there would be a similar impact on married individuals, but we haven't really gotten a good idea of what the updated brackets are under the president's proposal. On its face, the increase in the top marginal rate by 2.6% doesn't seem like it would have too significant of an impact. However, because the top bracket would also be expanded to cover individuals with income beginning at $400,000, some taxpayers may end up with closer to a 5% increase on their top rate instead of that 3% increase. The next area that has been a hot topic lately, especially within the last week, is increased capital gains tax rates. Under the current law, the highest capital gains tax rate is 20% with an additional 3.8% investment income tax assessed on net investment income that exceeds $125,000 for single people and $250,000 for married couples. And the additional tax applies only to passive income. It doesn't apply to sales that are related to an active business. So if we have, for example, John and Sue Doe sell a significant portion of their investment portfolio of publicly traded stocks, their capital gain on the sale is $2 million. Under current law, their capital gains tax is about $466,000. We've got 20% of their gain, so $400,000 plus that net investment income tax of about $66,000. Under the president's proposal, capital gains in excess of $1 million would be taxed at the top marginal ordinary income rate, plus the net investment income tax would still apply. So effectively over a 40% tax rate on capital gains in excess of $1 million. That would increase John and Sue Doe's capital gains tax liability on the same sale of their investment portfolio to $662,000. So a really significant tax increase as a result of the increase in that capital gains rate. What we're understanding from the current proposals right now is that this increase would essentially be a new tax bracket. So would apply to gains over $1 million, but the lower rate would apply to the first $1 million of capital gains. We really still don't have a lot of detail on this. So we're taking our best guess at how this will apply. So hopefully we get a little bit better detail soon, because of course this capital gains tax rate is going to be critical for planning not only sales of stock portfolios and those sorts of investments, but also potentially sales of land investments and other sorts of property. So keeping our eye on this one for sure. Additionally, the president on the campaign trail has proposed a change to the qualified business income deduction. Under current law, the qualified business income deduction allows a 20% deduction for income from pass-through entities and sole proprietorships, such as a Schedule C or Schedule F. This replaced the domestic production activities deduction on through the Tax Cuts and Jobs Act. So it's really only been in effect for about 4 years now. So if, for example, we have John and Sue Doe with a Schedule F farming operation with net income of $500,000, under the current law, they get a deduction of 20% of their Schedule F income. So they effectively only pay tax on $400,000 of their farming income. If we assume that their total taxable income is $400,000, that means their income tax is about $90,000. The president's proposal is to eliminate entirely availability of the QBI deduction for individuals making more than $400,000. So under this proposal, John and Sue Doe having the same amount of income would have income tax of about $125,000, an increase of about $35,000. This is because their income is in excess of that $400,000 threshold. So instead of getting a 20% deduction, they no longer have the benefit of that deduction at all. This will be critically important to watch, especially for farmers who have operations in partnerships, S corporations, and report as sole proprietorships. We hope that this provision doesn't get passed, although we recognize that if you're working with CPAs and other advisors, you're probably managing your income below that amount anyway. But there are sometimes, some circumstances out of our control that limit our ability to plan for that income. So definitely watching out for this one as well. The next area that is really important, especially for farmers, is like-kind exchanges. So tax law provides sort of generally that the general rule is that if you sell a piece of property and acquire another piece of property, you have to pay tax on the gain that you have on the sale of the property, even though you've just acquired additional property. Like-kind exchanges allow a taxpayer to defer the gain on the sale on the exchange of property. So if you ultimately don't cash out your investment and are really just swapping one piece of property for another, you don't have to recognize gain on that sale. And instead, you have to recognize gain when you sell that replacement property. The president's proposal is to eliminate the availability of tax-free exchanges for taxpayers who have more than $400,000 in income. So the effect of this provision is going to be really stark. Let's say that John and Sue Doe, with their Schedule F farming operation and net income of $500,000, trade parcel A farmland for parcel B farmland. Parcel A has a basis of $100,000 and value of $200,000. And parcel B, it has a fair market value of $200,000. Under current law, John and Sue would get to defer their $100,000 in gain. So instead of recognizing that gain on parcel A, their basis in their new property is $100,000. And when they sell parcel B, they'll recognize that gain that they deferred when they exchange the property. Under the proposal, John and Sue will recognize $100,000 in capital gain, and their capital gains tax will be $20,000 because their income is higher than that $400,000 threshold that the president has said is really the cutoff in terms of who is a high income earner and who is not. So really watch out for this as we go forward, because like-kind exchanges are used really often, and probably more often than we realize. So any change to like-kind exchanges, especially when coupled with some unforeseen increases in income, could be a really significant impact on the bottom line of your tax bill. Next, we've got the increase to corporate income tax rates. So under current law, corporate income is taxed at a flat 21%. Under President Biden's proposal, and congressional Democrats generally agree, they think that corporate tax rates need to increase to 28%. The effect of this is really pretty straightforward. Corporation A's federal income tax, if you've got $100,000 of taxable income, your income tax is $21,000. Under the proposal, the tax increases by $7,000 to $28,000. With entities, there's usually a bit of income tax planning that we can do to minimize federal taxable income. But again, there are sometimes circumstances where we can't manage that income. So a 7% increase in tax rates can hit pretty hard at the end of the day. We'll be watching to see where this all shakes out. We've heard some talk of a potential compromise at 25% instead of 28%. But at this point, we really think that the opening offer is going to be an increase from 21 to 28%. The next broad area of tax provisions that we really need to look out for is estate and gift tax issues. So under current law, the Tax Cuts and Jobs Act doubled the estate, gift, and generation skipping transfer tax exemptions to $10 million per person adjusted for inflation. So the 2021 exemption amount is $11.7 million per person. And what this means is that you can own at your death or give away during your life up to nearly $12 million in assets without having to pay federal estate or gift tax. These increased limits are currently set to sunset in 2026 and revert to $5 million per person adjusted for inflation. Our estimate is that in 2026, that'll effectively be about $6.5 million per person. So as a result of the historically high exemption amounts, very few people currently owe estate tax on their death. We've seen estimates that of the 2.8 million Americans that died in 2019, only about 4,100 estate tax returns were filed, and less than half of those returns resulted in any estate tax due. On the flip side, the current proposal that we've seen, although we haven't seen an official administration stance yet, there are several provisions that could garner Democrat support, and each of them result in significant increases in estate and gift tax liabilities. So the first suggestion that we've seen is removing the doubled exemption and reverting back to an estate tax exemption of about $5.9 million per person. Under this provision, if you're unmarried and farm more than 750 acres in Indiana, you may end up owing estate tax under this proposal unless you've got a significant estate plan in place. The next proposal that we've seen the most chatter about is reducing exemptions to 2009 law. In 2009, the estate tax exemptions were $3.5 million per person with a 45% tax rate. So if you're unmarried and own and farm more than 450 acres, you may end up owing estate tax under this proposal. So the lower the exemption amount, the smaller the amount of assets that you own can escape tax when you pass them on to the next generation. Another suggestion that we have seen that is really pretty alarming, especially for individuals with complex estate plans, is the suggestion that grantor trust assets, regardless of the structure of the grantor trust, should be included in the individual's estate. So currently, certain trusts are treated as owned solely by the individual who created them. And if they have certain provisions, they're excluded from that individual's federal taxable estate. If that provision were reversed and all grantor trust assets were included in an individual's taxable estate, it will result in significant tax liability, even if you already have an existing estate plan in place. So this is one that is really important to watch out for, and talk to your advisors about, do we need to revisit your existing estate plan? Do we need to get something in place right away? How are we going to structure it? So let's take a look at the estate tax rates. Currently, there are 12 brackets for taxable estates that start at 18% and max out at 40% for taxable estates over $1 million. A taxable estate is an estate where is the fair market value of the estate less your deductions and your lifetime exemption. So really, we're talking about estates in excess of about $13 million before you get to that 40% tax rate. There's, again, no official administration proposal out yet, but what we've heard is that there's some fairly broad support for a 45% flat estate tax rate. If we look at this example under current law, so with the current exemption amounts, and really just hone in on the increased tax rate, if we have John Doe who dies in February of 2021 with a federal taxable estate or a federal gross estate of 14.7 million, having made no other previous gifts, his taxable estate is $2 million. Under current law, the estate tax is about $746,000 for an effective rate of 37.3%. So under a flat tax rate, John Doe's estate tax is $800,000, so an increase of nearly $50,000, all other things being equal. Increased tax rates, especially switching from a progressive, meaning having tax brackets regime to a flat tax regime, will result in some significant tax increases, especially for individuals who are sort of on the bubble between having a taxable estate and not having a taxable estate. Additionally, we're seeing some significant discussion around reducing the gift tax exemption. Under current law, you have one single large exemption for both estate and gift tax. And so, you can make a total of almost $12 million in a combination of taxable gifts and your taxable estate. So if, for example, John Doe makes $11.7 million in lifetime taxable gifts, when he dies, the value of his federal gross estate is zero. He owes no gift tax or estate tax because the total exemption for both his taxable gifts and taxable estates is $11.7 million. We've seen several proposals decoupling the gift tax and instituting a separate gift tax exemption of $1 million. This could result in some significant gift tax liabilities for individuals who make large gifts, which is definitely not unheard of, especially if we're looking toward estate tax rates and estate tax rates increasing and exemptions decreasing. So if, for example, John Doe makes $3.5 million in taxable gifts in a year where the lifetime gift tax exemption is $1 million, John Doe will owe gift tax on $2.5 million in gifts, $3.5 million less than $1 million in lifetime gift tax exemption, and he'll have to pay gift tax on any subsequent taxable gifts in any subsequent taxable year. So this situation could very likely result in individuals who may have never owed gift tax before owing significant gift tax on an ongoing basis if they're trying to pass their assets to the next generation. Would definitely encourage you to keep your eyes on the gift tax exemption as well, especially those proposals that suggest decoupling the gift tax and instituting a separate exemption. The biggest area that is giving us a lot of heartburn is proposals that suggest eliminating the step up in basis. Under current law, assets that an individual owns at their death receive a tax-free step up in basis to the asset's fair market value as of the date of the individual's death. So if, for example, John Doe purchased a quarter section in 1980 for $2,400 an acre, and his basis in the land is $392,000. If he dies in February 2021, when the land is worth $7,600 per acre, or a total of about $1.2 million, his son inherits the land. So under current law, Paul's basis in the land is $1.2 million, and nobody owes any tax on that increase in value. If in August 2021, when the land is worth $7,700 an acre, Paul sells the land, his gain on the sale is $16,000. So $1.2 million sales price less the $1,216,000 basis. There are two different alternatives that we have seen in terms of eliminating the step up in basis, both of which have a very significant impact on the next generation of owners, especially for family farms. So the first alternative is that heirs would receive carryover basis. So heirs basis in the inherited property is the same as the deceased owner's basis. In the same facts as the previous example, under a carryover basis rule, Paul's basis in the land is $392,000, or what his dad's basis in the land was. If he turns around and sells that land in August 2021, his gain is going to be $840,000, whereas under the existing rule, his gain is about $16,000. The other alternative is the Canadian system, where there's actually a form of income tax that is owed at the owner's death, where the gain is realized as of the date of death. So if, for example, John Doe purchased a section of land in 1980 for $392,000, if he dies in February 2021, when the land is worth $1.2 million and his son inherits the land, under the Canadian system, John will recognize taxable gain on that untaxed depreciation of $840,000. His final income tax return will show that long-term capital gain. And then John's final basis in the land is $1.2 million. So his original basis plus the gain that he's recognized. Paul ends up receiving that increased basis of $1.2 million, but John has paid tax on that increase in value. Both of these provisions will result in significant tax, even to individuals who otherwise won't owe any sort of gift or estate tax. This rule applies regardless of the number of assets that you own during your life or the number of assets that get passed to your beneficiaries at your death. So even individuals who don't have a federal estate tax issue, even under lower exemption rates, likely will have a tax issue related to the untaxed appreciation and value of their assets at their death without some significant planning to work around these potential new rules. Again, the kind of planning that needs to be done based on these proposals really depends on which of these proposals ends up winning the day and gaining the most momentum. But definitely keep your eye on the step up in basis and whether Congress really looks like they're going to be acting to eliminate the step up in basis, because it will have a huge impact regardless of your federal estate tax position. There are some other wealth tax proposals that we've been seeing, although really these aren't likely to gain mainstream support, especially among moderate Democrats. Senator Elizabeth Warren has proposed a wealth tax, a 2% annual tax on net worth over $50 million, and a 3% tax on net worth over $1 billion. Additionally, Senator Bernie Sanders has proposed progressive estate tax rates, going from 45% for estates between $3.5 million and $10 million, up to 65% for states over $1 billion. Additionally, Senator Sanders' proposal targets several different kinds of trusts, gift tax exclusions to trusts, and estate valuation discounts. So definitely worth tracking to make sure that these proposals don't end up in the final tax package, although these really are fairly far out of what we would consider the mainstream for Democrats. So unlikely really to pass, but still interesting to watch. So let's talk about what you can do. That was a lot of sort of downer. Here are all of the different ways that you could potentially owe a bunch more tax. So let's talk about what you can do about it. These are lessons that we learned from 2017 in the Tax Cuts and Jobs Act. And a lot of these we in particular learned through hindsight, but we would suggest first organize. So prepare by understanding your current situation, keep on top of the news, research the new proposals, determine the potential impact on you, and identify the resources and advisors that you want to work with on your next steps. One lesson that we learned from 2017 is that even when policies and proposals are uncertain, it isn't too early to get started sort of identifying what your opportunities for changes are in order to put yourself in the best possible position to adapt to changes in the law. Next, strategize. So identify and analyze your potential challenges and opportunities. Brainstorm within your business and with your advisors to create these solutions that are going to allow you to be flexible with your tax plan and make sure that you can implement a plan that minimizes the impact of any of these proposals on your business and on your personal situation. Next, reflect. So assess the short and long-term implications of the solutions and strategies that you and your advisors develop. Make sure that they fit with what you want long-term for your family and for your business, and consider whether they really meet your goals. Next, optimize. So take all of those different options that you have and determine which of them best fit with your situation and with your family. Tailor all of these solutions to match your true individual needs. Capitalize on these opportunities and minimize your risk and exposure. And then implement. So work with your advisors to put these strategies to work. And hopefully at the end of the day, you'll be in, at the very least, a better position than you would be had you not gone through the exercise. Kayla, any parting thoughts that you want to lend to us on these issues?
It's a lot to take in, and like Beth said, it does kind of sound like a Debbie Downer, with a lot of the tax and increases and things going on. But what I would say is don't panic and just be patient with some of this information. As Beth said, there's a good way to look at this based on what we've seen previously in other from 2017. So kind of walk through those steps: optimize and strategize, reflect, optimize, and implement with it. And just take steps. Take it one day at a time, one issue at a time. But know that, between us and Indiana Corn and Soybean Association, we're all going to watch this. Beth, one of the things that I was thinking about is because of so much debate going back and forth, how can members or producers really get active and help kind of affect change? Is there a way for them that you've seen from our 2017 to now changes?
Being involved in your industry associations is a very, very good step that gets a lot of impact. There was a lot of work with the Indiana Corn Growers Association and the national associations to really put together what the true bottom line impact would be on the average farmer. And ultimately, your organizations were able to convince Congress to make some changes. So don't underestimate the power of participating in your associations that you're a member of. Encourage them to work with your Congress people to make changes to laws that definitely will negatively impact you. One thing that has gotten so much easier since 2017 is being able to stay in contact with your elected representatives, write letters, put pen to paper, send emails, call them, especially if you're a constituent and it's going to have a huge negative impact on you. Your elected representatives may not want to hear from you frequently, but they need to. So definitely stay as active as you can. I recognize that everyone is super busy, and that staying involved is something that's really difficult to do. But again, this is where the industry associations are so critical, because they can help you stay engaged without as much active input on your part.
With that, Steve and Rachel, I think we are ready to turn it over if there are any questions.
I don't believe there's any, I don't believe there's any questions yet. Rachel will let us know if there are. But I think, just kind of dovetailing off what you folks were just talking about is how can we impact the change? And it's important what we're doing now is trying to sort through all the noise to figure out what might happen, but continue to engage so we know what the proposals actually are. And we can come up with different examples of how it impacts the average farm, and we can tell that story. But I think it's even more important that that farmers can tell us what it really does to their farm, so we can convey that to their member of Congress. They represent the district, or if they're a senator, they represent the state. They hear from staff, from us quite often. But the biggest impact we can have is when we kind of sort through all these different proposals, go through examples, but then apply those scenarios to your farming operation and show exactly what that impact's going to be, good or bad. Whether it's something that we think is good and we're really advocating for it. If we think it's something bad, we're trying to slow it down or stop it. We need to tell those real life stories. So that's where we really need the farmers to plug into this discussion, to apply those proposals to their farm and show real world examples of what that impact's going to be. Because again, a member of the U.S. House represents their district. They need to hear from their constituents, and we can show then, as we get these real world examples from farmers about what that impact is on their farm, we can tell a broader story about what in this case, a negative impact would be on their district. And just about every congressional district in Indiana is very reliant on agriculture, so they need to hear what these changes will mean to Indiana corn and soybean farmers. So and I really like that slide. Just what do we do about it? Because we know that we're not going to necessarily like all this, but what can we do to understand it more, and then most importantly, look for opportunities, either to change the opportunities to change the policy, or opportunities to build our business plans around what the reality is. So I really appreciate the presentation today, Beth and Kayla. We really do appreciate you joining us and providing this insight. This is what we do on behalf of corn and soybean farmers all the time, is just try to track what's out there and try to stay ahead of it, so we're prepared when things really start to happen, so we can tell a stronger story. If you have questions for either of our panelists, their contact information is right here. And I do want to say, and I think we got a slide on this later, but kind of in the spirit of understanding what these tax proposals mean, not just because immediately we start thinking about estate taxes, which is extremely important to understand what that impact would be and how to manage that, but also the near-term tax implications on an operation, and how to position yourself in the best possible way to manage to manage those implications. So we're going to have throughout the summer, we're going to have smaller group discussions, and it's no obligation, but it's just similar to what we did here, but more of a small group setting, so you can really put your operation, plug your operation into these proposals, and actually this, as we hold these meetings, we'll know more about what the proposals really are. Again, a lot of this was based on the talk around it, which it matters, but we won't know for sure what the proposals will be and what all the variables will be until later. So we'll have a better handle on a lot of those. So as we have these Cup of Joe with Keiko, as we have those meetings, I think it's important for farmers to understand that those implications. But it's important for us then to kind of gather that, not specific details from an operation, but generally what's it mean to the average farm, and then also help build your story as you tell your elected officials what this means. So I'm really looking forward to the Cup of Joe with Keiko coming up. We're going to, as restrictions lighten, we'll know more where we can have them, how we can have them, and all that. So be watching for those. Looking forward to that, so we can put some really effective advocacy in tax policy coming up this year. And just save the date for July 27th. We're going to have our Ag Policy Summit. That's the topic. I think we may touch on some tax issues, but the big topic of that day is climate, and what how do we get our hands around all the various proposals in climate policy? What's that mean for farms? How do farmers find places to trade carbon credits? So what is that market? How's that market developing, and who are the players there? And then how do you measure what you're doing on the farm and verify what you're doing? So that policy summit will be kind of centered around the sustainability policy that we see coming up in the next year. Next slide, please. And I see that Mike Caney was able to join us, and we are recording this. I should have mentioned that at the beginning. So if you need to go back and review any of the presentation, we did record it, so you can do that. We'll have it housed on our website. But also, it's 70 degrees here and sunny, and it's the end of March. And we know that farmers aren't going to slow down in the middle of the day for a webinar. It's a very important webinar, very important topic. So we are recording that to make it available for them to view on their own. And Mike is out doing some kind of work today. I'm not sure what he's up to today, but we've asked him to just give us a little information about membership. So Mike.
So good afternoon, Steve. Great to be here. You kind of hit the nail on the head there. We just got to remember to tell our stories and how these tax things are going to affect us. And there's no better way than to let us, be a member of the ISA and the ICGA, and let us go and fight for you on your behalf on what you want. We put a lot of time and effort into this, and we get a good relationship with all of our senators and representatives to do this. So it's just important to become a member, and we just got to stay on top of the issues that are coming ahead. So with that, back to you, Steve.
Well, thank you, Mike. And again, the membership, $150 a year for a joint membership. That's the best deal that we can offer. And again, it's a small investment to make sure that your voice is heard for your farm in both in Washington and in Indianapolis. So thank you, Mike. Next slide, please. And I believe Courtney has joined us. I don't know if she's able to close us out. I don't see her up on the screen yet. Rachel, if you can give me a sign one way or the other, if Courtney has any thoughts from today. I know that's like I said, a very, very interesting topic, and I look forward to, as these proposals come out, really digging into them and seeing what they really mean and putting real stories behind that. Courtney, you're on the
Hey,
road
I don't know
too.
if you guys can hear me. Sorry.
Yes,
Yeah.
you sound just fine. Go ahead.
Yeah. Thank you. And thank you to Keiko for all of this information. It was, I have to admit, it was pretty sobering, the information that you guys were sharing. And so to echo what Mike and Steve have said, it's important for us as members, and for staff, and really for you guys as the farmer members, to pull those stories together and help the elected officials understand how their decisions impact folks, that these aren't decisions that are impacting, other people in other places, that the decisions are really impacting their constituents, their neighbors, their community, business people in the community. And so it's important to really have a voice in that. I thought it was really great about also sharing the information of what the farmer members and what the farmers of Indiana can do, that while the information sounds tough and sounds a little grim, that there are ways to manage through it and to think about that and to talk to your advisors and to have those honest and transparent conversations with the advisors of what's best for your organization, your family, your operations, and have those inputs and plans in place. So really enlightening information, really helpful, really appreciate again our partners at Keiko. I am looking forward for the Cup of Joe with Keiko, because I want to show up with my family's farming operation and say I want to plug it into their calculator and see how that's going to work as well. So I'm looking forward to joining a Cup of Joe with Keiko. So thank you to everybody. And Steve, I'll turn it back to you.
All right, thank you, Courtney. I believe this concludes our program. Thanks again to Coe Isom for their continued support of Indiana Corn Growers Association and the Indiana membership, or Indiana Soybean Alliance Membership and Policy Committee. We couldn't do that work without our membership, and we couldn't do it without the corporate partners. And Keiko's been a very strong supporter of our efforts, and we look forward to that continued support. So thanks again for your expertise in this area, and look forward to working with you as we move forward throughout the year. Thanks again, everybody.
Thank you.
Thanks, guys.